I want you to imagine you're looking at the stock market in early 2025. Everything is hitting all-time highs. Tech stocks are soaring. And everywhere you look, there's one word driving the entire rally: artificial intelligence. NVIDIA's stock has quadrupled in 3 years. Microsoft's market cap has blown past $3 trillion. And AI startups you've never heard of are raising billions at valuations that would make even investors blush. It feels unstoppable. It feels like the future. But here's what most investors don't see. Beneath all that euphoria, there's a pattern emerging. A very familiar pattern. One that I watched destroy fortunes back in 2000 when the dot-com bubble collapsed and the Nasdaq fell nearly 80%. The difference this time, the money isn't just flowing into AI companies. It's flowing in a circle. The same capital appearing on multiple balance sheets as revenue. The same hardware being financed and repurchased by partially owned subsidiaries. This isn't a revolution. It's a financial ouroboros. A snake eating its own tail. And the math doesn't add up. Let me show you how this works. A massive chip manufacturer, let's say NVIDIA, invests billions into a small AI startup. That startup then uses that exact cash to buy chips back from NVIDIA. NVIDIA records this as revenue and growth, which sends their stock price soaring. But here's the problem. No real value was created. The money just moved in a circle. This practice has a name. It's called rounding, and it was central to multiple scandals during the dot-com era. Companies like Enron and WorldCom used similar tricks to dazzle Wall Street before collapsing overnight. Today, we're seeing it happen again, but on a scale that makes the 1990s look tame. NVIDIA recently proposed a $100 billion pledge to support OpenAI's data center expansion. Sounds impressive, right? Except OpenAI will use that capital to purchase NVIDIA's hardware. The money flows out as investment and returns as revenue. Microsoft has invested $13.8 billion in OpenAI and now holds 27% of its for-profit entity. In return, OpenAI has agreed to purchase up to $250 billion of Azure cloud capacity through 2032. That's $250 billion flowing right back to Microsoft. Amazon committed up to $8 billion to Anthropic. Then Microsoft and NVIDIA agreed to invest another $15 billion, $5 billion from Microsoft, $10 billion from NVIDIA. In exchange, Anthropic commits to purchase $30 billion of Azure compute running on NVIDIA systems. Do you see how messy this is getting? And here's the most explicit example. Elon Musk's xAI is structuring a $20 billion special-purpose vehicle that will buy NVIDIA GPUs and lease them back to xAI. NVIDIA is reportedly contributing $2 billion of equity for the same vehicle, while also supplying the hardware, effectively financing a portion of its own future sales. Venture capitalist Azar called this ecosystem a financial ouroboros. That's not hyperbole. It's an accurate description of what's happening. Now, individually, these deals appear commercially rational. But when you aggregate them across the industry, they reveal something troubling. The same capital appearing on multiple balance sheets as revenue. Growth that looks explosive but is largely internal to the ecosystem, rather than driven by external customers or genuine economic value creation. Financial firms, especially global systemically important banks, have begun flagging these circular arrangements as concerning. They recognize that when suppliers finance their clients, share ownership, and split revenues, the interconnected nature can inflate demand signals, distort revenue metrics, and obscure underlying vulnerabilities. And that brings us to the second warning sign. Because here's what nobody's talking about. These AI companies are hemorrhaging cash at rates unprecedented in technology history. OpenAI provides the most dramatic example. According to Microsoft's own financial filings, OpenAI lost more than $11.5 billion in a single quarter. That's an annualized cash burn rate of approximately $46 billion. This isn't a controversial estimate. It's straightforward division. OpenAI now spends $3.30 for every dollar it earns. Deutsche Bank projects $143 billion in cumulative negative free cash flow through 2029. The analyst noted that no startup in history has operated with losses on anything approaching this scale. We are firmly in uncharted territory. Let me simplify why this is happening. OpenAI trains models on NVIDIA GPUs accessed through Microsoft Azure cloud infrastructure. Every time someone uses ChatGPT, OpenAI pays NVIDIA's margin plus Microsoft's margin plus its own operating costs. It's like paying rent to three different landlords just to open your store. Compare that to Google. Google trains Gemini entirely on its own tensor processing units. No external GPU purchases, no cloud provider margin stack. According to semiconductor research firm SemiAnalysis, Google's TPU infrastructure delivers 30 to 44% lower total cost of ownership than NVIDIA's systems. This cost gap isn't temporary, it's structural, and it widens with scale because every additional query OpenAI serves multiplies the margin disadvantage. The market is starting to notice. Gemini reached 650 million monthly active users in Q3 2025, while ChatGPT's US traffic declined 35% in November 2025. Mark Benioff, the Salesforce CEO who had used ChatGPT daily for 3 years, posted to his 3.2 million followers, "I'm not going back." And it's not just OpenAI. CoreWeave, the infrastructure company providing GPU access to various customers, ended Q3 2025 with $14 billion in debt with unsecured senior notes carrying a steep 9% interest rate. The company projects a $1.09 billion net loss for 2025. With CoreWeave stock trading at a steep fall from peaks above $180 to below $70, the market has begun pricing in execution risk and the possibility that these companies cannot service their debt load if infrastructure utilization or pricing declines. The fundamental issue is this. AI companies require extraordinary compute resources to train and serve models. And these resources cost money far in excess of what current customers are willing to pay. The solution has been to have investors provide the capital, either directly as equity investments or indirectly through cloud provider commitments to purchase infrastructure. But this solution only works if the end customers for AI services eventually generate sufficient revenue to justify the infrastructure costs. If they don't, the entire structure becomes unsustainable. Now, here's where things get really interesting. And by interesting, I mean deeply concerning. There's another critical issue that's emerged. Accounting practices that systematically overstate hyperscaler earnings. What some analysts are calling a $176 billion depreciation arbitrage. Phantom earnings that disappear when you apply realistic depreciation schedules. Let me explain. Traditional servers were historically depreciated over 3-year periods. In January 2020, Amazon changed the depreciation schedule for its server assets from 3 years to 4 years. By 2023, all three major hyperscalers, Amazon, Microsoft, Google, had normalized on 6-year depreciation schedules for their infrastructure assets. This extension from 3 to 6 years had a massive impact on reported earnings because companies can spread the same capital expenditure over twice the time period, reducing annual depreciation expense and thereby improving reported net income. But in January 2025, Amazon made a striking reversal. The company shortened the useful life for servers supporting artificial intelligence and machine learning workloads from 6 years back to 5 years. In their disclosure, Amazon cited the pace of change with respect to AI and ML technology as justification. This was explicit acknowledgement that AI hardware becomes obsolete faster than general-purpose infrastructure because each new GPU generation renders prior generations economically uncompetitive. The accounting impact was immediate. $700 million in additional annual depreciation expense, reducing net income by approximately $298 million per quarter. Yet, here's the troubling part. Amazon's action demonstrated that GPU hardware depreciates faster than previously assumed, but other hyperscalers have not made similar adjustments. This means that the same assets, identical GPU hardware, receive dramatically different treatment on different companies' balance sheets. And the secondary market for GPU capacity tells us even 5-year assumptions are optimistic. GPU cloud rental rates have collapsed from approximately $8 per hour for H100 equivalents in early 2024 to approximately $210 per hour by late 2025. That's a decline exceeding 70% in under 2 years. Princeton's Center for Information Technology Policy published research documenting that GPU hardware is being essentially given away in certain hosting arrangements with providers prioritizing utilization over pricing to maintain competitive positioning. Multiple cloud providers are offering H100 capacity at rates below their own cost of capital, accepting losses to maintain market position. This behavior is consistent with hardware whose economic value is declining faster than accounting useful lives recognize. According to analysts Michael Burr and others, the depreciation arbitrage, the gap between accelerated and extended depreciation schedules applied to identical hardware creates phantom earnings exceeding $50 billion annually across the hyperscaler complex, with cumulative impact through 2028 reaching $176 billion. If hyperscalers were forced to use realistic depreciation schedules reflecting the actual economic life of GPU hardware, their reported earnings would decline substantially, potentially eliminating the profit growth that justifies their elevated valuations and continued capital expenditure. Now, you might be thinking, okay, but this is just growing pains. Eventually, demand will catch up. Let me show you why that's unlikely. In 2025, hyperscalers committed approximately $400 billion to capital expenditures, up 70% from 2024. Goldman Sachs Research expects this spending to continue increasing, with consensus estimates reaching $527 billion for 2026. To put that in perspective, AI infrastructure needs approximately $2 trillion in annual revenue by the end of the decade to justify the current and planned investment. That's an insane amount of money. Nobody has it, and nobody may ever have it. Here's the problem. Big tech companies have large cash flows, but the trillions needed are too steep even for them. Venture capital isn't interested in funding infrastructure directly. So, what's filled the gap? Private credit. The private credit market now manages close to $2 trillion in assets, representing 17% year-over-year growth. Much of the AI build-out is now being financed through complex private credit structures involving multiple lenders and syndicated arrangements. But here's the dangerous dynamic. GPU equipment is being used as collateral for loans financing the purchase of additional GPU equipment. If GPU prices decline, as they already have dramatically, or if utilization rates fall below projections, the collateral values evaporate while the debt obligations remain. And then there's the physical constraint nobody's talking about: power. Hyperscale data centers operating at 100 megawatt or more are becoming standard. A single 1 gigawatt data center requires approximately $10 billion in construction costs and another $20 billion in GPU equipment costs, while consuming energy equivalent to that used by 100,000 homes. To meet projected AI compute demand, the United States needs to build 75 to 100 gigawatt of new generation capacity by 2030. But new power generation facilities typically require 3 to 5 years of construction. Data centers are being built on schedules of 2 to 3 years. This is a dangerous mismatch where demand for power capacity has outpaced the grid's ability to provide it. Researchers at Carnegie Mellon University warned that heavy concentrations of data centers could push residential electricity bills up as much as 25% in some regions. The power grid constraint creates a hard ceiling on how much AI infrastructure can be deployed. Unlike capital, which can theoretically be raised in unlimited quantities, electricity generation capacity requires physical construction that cannot be accelerated indefinitely. If AI infrastructure deployment hits this physical constraint before end customer demand materializes, the entire structure faces collapse. And here's the most telling sign. The smartest money in the room is starting to quietly sell. In November 2025, Peter Thiel's hedge fund sold off its entire holdings in NVIDIA. This is the venture capitalist and PayPal founder who famously bet big on technology trends. The timing was significant, coming as NVIDIA itself was facing margin compression pressure from rising input costs. SoftBank, which had been one of the most bullish investors on AI, experienced dramatic stock volatility despite posting a $19 billion gain in its vision fund related to rising AI valuations. The market wiped out nearly $50 billion in market cap as AI bubble fears gripped investors. Google DeepMind CEO Demi Hyabs issued a stark warning in late 2025, suggesting that many startups are riding a bubble that could soon burst. Coming from the head of one of the world's most advanced AI research laboratories, this warning carried particular weight. While some continued promoting AI investments publicly, private actions by sophisticated insiders, those with access to financial statements and strategic information, indicated growing caution about the sustainability of current trends. The pattern is undeniable. During the dot-com crash, which peaked on March 10, 2000, the Nasdaq fell 75%, wiping out $1.75 trillion in value. The telecommunications crash that followed in 2001 was more severe, with companies owing $1 trillion, much of which will never be repaid, according to Federal Communications Commission testimony. But this AI infrastructure bubble could be worse. The financing is increasingly reliant on private credit and leverage, not just equity. The interconnectedness of hyperscala balance sheets means that problems at one company could ripple through the entire ecosystem. And the circular financing mechanisms mean that the same capital appears on multiple balance sheets as revenue, obscuring the true scale of leverage embedded in the system. When these arrangements unwind, when AI startups stop purchasing hardware from their investors, the revenue evaporates across the chain and companies simultaneously face both revenue declines and collateral impairments. It's not a question of if this happens, it's a question of when. The most likely scenario is not an immediate collapse, but a grinding compression where the profitability gap between AI infrastructure build-out and end customer demand gradually narrows the viability of ongoing expansion. This could unfold over 18 to 36 months, creating enormous losses for late entrants. Well, I'm not a financial advisor. However, these are the things I'd be focusing on if I were you. Firstly, recognize that we're in the late stages of a cycle driven by circular financing, not genuine end customer demand. When vendor financing unwinds, valuations compress rapidly. Secondly, pay attention to depreciation schedules in financial statements. Companies still using 6-year assumptions for GPU hardware are overstating earnings. That's not an opinion, it's math. Thirdly, watch insider behavior more than public statements. When sophisticated investors like Peter Thiel exit positions while promoting them publicly, that's a signal worth heeding. This is exactly why my friends lost millions during the crash while I kept investing through the downturn. I focused on companies with genuine business models, not circular revenue loops. Make sure to subscribe if you want to grow your wealth and understand the patterns that separate real growth from financial illusion. Okay, I'll see you later.